The Titanic had lifeboats for only 534 people, but there were over 2,200 people on board. The designers didn't plan for a disaster because they believed the ship was unsinkable. As a result, 1,500 people died. Every financial disaster in history shares the same root cause. It's not a bad luck or a bad timing. It happens for one simple reason, that is, there was no room for error. This is chapter 13 of the Psychology of Money Room for Error. This chapter looks at everything we have learned so far. The future is unpredictable, surprises will happen, and risk is always there. It then asks a very practical question. What should you actually do about it? The answer is simple. You must build room for error into every single financial decision you make. Every single one. Room for error is also known as a margin of safety. It is the gap between what could go wrong and what you can survive going wrong. It is your safety cushion. It is the breathing room that protects your plan when reality gets messy. Here's how Morgan frames it. You can be optimistic about the future while still admitting that the path to that future will have surprises. Building room for error is not pessimism. It's the admission that while you will likely succeed, but it isn't a guarantee. Think about a bridge. Engineers don't build a bridge that can hold exactly the maximum expected weight. They build it to hold 3 or 4 times that weight, not because they expect 3 or 4 times the traffic, but because they know their estimates might be wrong. And if a bridge isn't strong enough, it doesn't just bend, it collapses completely. Your finances works the same way as that bridge. If your plan only works when everything goes right, when you keep your job, when the stock market goes up, and when no emergencies happen, then it isn't really a plan. It is just a prayer. Building room for error means asking yourself, what happens if I am wrong? What happens if I lose my job for 6 months? What happens if I have a medical emergency? Can you survive these situations? If the answer is no, you need a bigger safety cushion. Morgan argues that this is the single most important part of financial planning, not returns, not asset allocation, not tax optimization, but room for error. Because without it, one bad break, just one, can destroy decades of hard work and good decisions. Let's look at our first story, long-term capital management. In 1994, a company called Long-Term Capital Management was started by John Meriwether, the most famous traders on Wall Street. His team even included winners of the Nobel Prize in economics. This wasn't just a hedge fund. It was arguably the smartest group of financial minds ever put in single room. For 4 years, they were perfect. They made huge profits, and investors were begging to invest in their fund. Their mathematical models predicted risk with what they believed was near-perfect precision. And here was their fatal flaw. They had almost no room for error. Their strategy used enormous leverage, which means they borrowed massive amounts of money to make bigger bets. For every $1 of their own, they bet $25 of borrowed money. When you borrow that much, a tiny mistake becomes a total disaster. If their investments drop by just 4%, they would lose 100% of their money. There was no safety cushion at all. And in 1998, the impossible happened. Russia defaulted on its government debt, an event their models calculated had a probability so low it was essentially zero, but it happened. Because they had no safety cushion, this one impossible event ruined them. They lost $4.6 billion in less than 4 months. It was so bad that the Federal Reserve had to organize an emergency bailout, not to save them, but to prevent their collapse from dragging down every major bank on Wall Street. Even the world's smartest people can lose everything if they don't plan for things to go wrong. Let's look at our second story, the seatbelt analogy. Every time you get in a car, you put on a seatbelt. You don't do this because you plan to crash or because you think something will go wrong today. You do it because you might be wrong about today being a safe day. It takes only 2 seconds to buckle up. It costs you almost nothing. But in the rare event that you need it, it saves your life. In your finances, room for error is your seatbelt. It has a small cost. You might make slightly less profit or spend a little less money right now. But when a financial crash happens, and it eventually will, then this safety cushion saves you from losing everything. And just like a real seatbelt, you can't put it on after the crash. You have to wear it before. The best time to build your safety cushion is when things are going well, not when everything is already falling apart. Let me show you what happens when an entire country has no room for error. In 2022, Sri Lanka experienced one of the most dramatic economic collapses in recent history. And it's a perfect case study in what happens when a country, just like an individual, operates with zero margin of safety. For years, Sri Lanka's government had been spending far more than it earned. It borrowed heavily from international lenders. It funded massive infrastructure projects, a port, an airport, highways, but many of them never generated the revenue they were supposed to. By 2019, the country's foreign reserves were already dangerously low. But instead of building a cushion, the government cut taxes massively in late 2019, reducing revenue by an estimated $1.4 billion per year. They were betting that everything would go right, that tourism would keep growing, that exports would hold steady, that nothing unexpected would happen. And then COVID hit. Tourism, which accounted for about 12% of Sri Lanka's GDP, collapsed overnight. Remittances from workers abroad dropped, export revenue fell. The few dollars the country had in reserves started evaporating. By early 2022, Sri Lanka had almost no foreign currency left. And without foreign currency, a country cannot buy imports. And Sri Lanka imports almost everything: fuel, food, medicine, raw materials. The consequences were immediate and devastating. Fuel ran out. People waited in lines for days, literally sleeping in queues to get a few liters of petrol. Power cuts lasted 13 hours a day. Hospitals ran out of medicine. Food prices doubled, then tripled. In July 2022, tens of thousands of Sri Lankans stormed the presidential palace. President Gotabaya Rajapaksa fled the country on a military jet. The government collapsed. A country of 22 million people brought to its knees. Not by a war, not by a natural disaster, by the simple, devastating absence of room for error. The individual Sri Lankan families who survived the crisis were the ones who, despite living in the same country, had personal room for error. They still suffered, everyone did. But they didn't starve. They didn't lose their homes. They had a buffer, however small, that gave them time to adapt. The families with no savings and lifestyles built on the assumption that tomorrow would be the same as today, they were the ones in fuel lines for 3 days. They were the ones who couldn't buy medicine for their children. This isn't about blaming individuals. The government failed catastrophically. But it is about recognizing that room for error works at every scale. Countries need it, companies need it, and you need it. Because when the unthinkable happens, the only thing standing between you and catastrophe is the margin you built when times were good. So the obvious question is, how much room for error is enough? And Morgan gives us a framework for thinking about it. Morgan suggests thinking about it in layers. Layer 1, cash buffer. Keep enough cash to cover 6 to 12 months of expenses. Not invested, not in stocks. Liquid, accessible. This is your emergency fund. Even if your every investment goes to zero, you can eat, pay rent, and think clearly for a year. Layer 2, conservative assumptions. When you plan for the future, like retirement, children's education, don't use the best case scenario. If the market historically returns 10%, plan for 6%. If you expect your income to grow 15% a year, plan for 8%. If you think you'll work until 60, have a plan that works if you stop at 50. Layer 3. Avoid single points of failure. Don't put all your money in one stock. Don't rely on one source of income. Don't have all your investments in one country. Every concentration is a potential point of total failure. Spread it out. This creates a financial life that can absorb almost anything. You might not get the maximum possible return, but you'll be alive. You'll be in the game. After I truly understood this chapter, I changed how I handle finance. I stopped trying to get the most profit and started focused on protecting what I have. I used to think that keeping money in a savings account was a waste. I thought, why earn 4% in the bank when I could earn 12% in the stock market? But I was wrong. That cash isn't being wasted. It is buying me a guarantee, the promise that I will never be forced to sell my stocks at a bad time. Without a safety cushion, this is what happens. If market crashes by 40% and you have a sudden emergency and you have no cash in the bank, then you are forced to sell your stocks while the price is at the bottom just to pay your bills. Keeping extra cash is like having a bodyguard. It protects your money from the panic version of you that shows up during a crisis. Today, I keep about 1 year of expenses in cash. Every advisor tells me that's too much. You are losing profit. On paper, they are right, but I sleep perfectly at night. I have never panicked and sold my stocks in a scare. Over many years, that emotional stability has made me far more money than the extra 3% I lost by holding cash. Room for error isn't a cost. It is the price you pay for a long, successful life. It is the cheapest insurance you will ever buy. There are 3 takeaways from this chapter. First, accept that you will be wrong. Not might be, will be. Some of your financial assumptions will turn out to be incorrect. Some of your investments will underperform. That's not a possibility, it's a certainty. And once you accept that certainty, building room for error stops feeling like pessimism and starts feeling like intelligence. Second, choose your risks so that one single mistake cannot destroy you. For every investment decision, ask yourself, if this goes to zero, am I ruined? If the answer is yes, then you are taking too much risk. Reduce how much you have invested. Add a safety cushion. No single event should ever have the power to end your financial life. Third, build your safety cushion during the good times. Do not wait for a crisis, a job loss, or a market crash. Build it right now, while things are stable and you still have money coming in. By the time you actually need a safety net, it is too late to start making one. That's Chapter 13, Room for Error. The chapter that teaches you that the difference between surviving and collapsing is never talent or luck. It's the margin you built when nobody was watching. In the next video, we cover Chapter 14, You'll Change. And this one is surprisingly personal. Morgan argues that the person making your financial plan today is not the same person who will be living with that plan in next 20 or 30 years. Your goals, values, and priorities will change. And any plan that doesn't account for that is destined to fail. Like this video if it made you want to check your own margin of safety. Subscribe and tell me in the comments, what's the biggest financial what if that scares you? The answer might reveal where you need more room for error. See you in the next one.